Welcome back to another episode of Follow the Money. My name is Joshua Belanger, and today we're going to cover trade this and fade that. So let's get right into it. Right now we're looking at Box. This is a chart of Box. Now, if we compare this to the NASDAQ, this has been lagging compared to the overall NASDAQ. And also, when you think of Box, the storage company, you also think about the fact that this was almost could have been a stay-at-home play. Now, this is one I lost money on early back in August here, had a trade here. And that whole theme, that thing I was anticipating as well, the stay-at-home trade, this backed off and then broke down. Now, this company has been struggling and just announced after the market, and it's down about 5%, is that they're laying off about 11% of their workforce. That's pretty meaningful. If a company cannot make money in the booming time that that company should be making money, that's a tall sign. So that's why this one is a fade it. Now we have a break below here, and honestly, this would be one I would be looking to short. There's different ways to do it. You could sell call spreads against it. I don't necessarily think it right now would be the time to time it perfectly for a breakdown. You could look to do something where trading is always about a balanced portfolio. So you want some positions that are long and you want positions that are short. This would be a short here. I would be looking for it to retest how that time frame would be. It's tough to short against a strong market or a market that's manipulated as we see now. So that's why it's a tough one. There's different ways to do it, but this for sure is not a long. It's a fade and sell it. Now here's one that I want to buy. And the buy on this one is going to be on net. Now net, quite the opposite. This is another one that has been booming, and we had a pullback here. I'm actually in my Wealthy Tech portfolio that I recommend to stock pick once a month. This is a position that we actually got back in all the way into June and has seen heavy profits or heavy paper gains. We haven't exited out of it yet, but it's been a well-timed position here, and it only, to me, I think it continues to go higher here. I think it goes at least to 100 before it backs off a little bit, consolidates, and so forth. The reason why I think it's a good trade right now, option-wise or trade-wise, is because of the activity we saw here. So we have a pullback. We got that pullback, snapback here. We're starting to see prices lift back up and look to retest highs. So when we look at the option market here, we look at the contracts that expire in 9 days. This is why I like to follow the money. It's a bit of a nerd in me, especially when it comes to the stock market. I want to know where money's going. If you're in the casino that have the eyes in the sky, those casinos always want to know where the whale's at. Why? Because the whale is the risk to the operation. That's what can take a casino down. They want to know where the whales are, what they're betting. The minnows don't really mean anything. That's why when I see whale trades like this, it's meaningful and it's interesting. So this is not a big whale, but this is meaningful on the fact that 9 days to expiration, we have 8,000 contracts traded, and they were buying these around from $1.80 all the way up there. So we'll have to look at the open interest tomorrow. But nine days, you have time that's going to be eating away at you. You're paying a decent amount of money for these as well. So I imagine some of this was two-sided trading. That's why it's important to see what sticks tomorrow. So when I look at this is hot money. This is money I like to see. But I wouldn't position exactly the way they would. For one contract, you're paying about $2.50. How could we structure that? And that's the beautiful thing about options. So we've talked many times before about a calendar. I would look to do a calendar on this one. And we don't really have the exact calendar on this one because this probably is, they don't have an 84. So I would look at something maybe, I guarantee that has an 86. Yep. So we have an 86 here. So this would be buying that, or selling the 22 and buying the 29. That could be done for $1.10. So for $110, you could have a position that benefits on an increase in the next 16 days, because what's going on is you sold the contract that expires in 9 days. You're taking that and you're buying the longer dated. So you're using the skew in time in your favor here. Now, of course, in 16 days, if it doesn't pan out and it doesn't go higher, you lose the $1.10. But just that simple approach, and not simple, but just that balance of risk and structuring it benefited with the lower cost reduction, the lower debit. And now we have a position here that in case they are wrong on time, which which does happen, we have a little bit of time on our hand and we could see prices or bet prices go back into 86, even retouch those highs at 88. So this is a play to retest highs. This is the way to structure it, and that's trade this and fade that. We'll see you in the next video, and make sure you like, subscribe, and leave a comment too. I love hearing from you, and I'll see you in the next video. Take care.